Perfect, perfect. So you're able to bring in your PIA, correct? Your primary
Yes.
insurance amount. Okay.
Yeah.
And you're able to bring in your investment or 401k statements and all that.
Yeah.
Okay.
And I'm probably a little bit of a small fry here, so, you know, I don't want to, I always feel, I hope I don't take too much of your time, not a lot of result, but I feel like at my age, I should be further along than I am, but we'll see what you think.
Okay. And that's fine. I mean, our goal here is to try to help you pick the right Social Security option.
Okay.
Bottom line.
Okay.
So what I'd like to do is ask you a few questions initially to, so that we can then have our team start to work on the Social Security report we promised, which will help us quantitatively determine what is, you know, the best option or options for you to take.
Okay.
Then while they're working on that, we'll go into the second part, which has to do with now integrating your other investments and other accounts into this to see if the option that the computer spits out is actually the most viable option for you. Fair enough?
Yep.
So first, let me get your birth date, please.
Okay. August 23rd, 53.
Okay. When do you think you'll retire?
I truly believe I will not be able to retire until the latest possible time. I did a lot of things later in life. I adopted a child from China a few years ago. He's now 8. He has a little bit of special needs. So we're working with, he's got a very good medical policy and a medical group behind him, and we've got a lot of good support, but anticipating that there's going to be a lot of out-of-pocket expense for some of his dental needs and his other surgery needs when he's later in life, in his 20s. So bought a house a little bit later in life, you know, first house in 2005.
Are you single or married?
I'm single, living with, that's where I have a lot of questions, whether or not it makes some sense for us to get married, you know, if that's even an option for him, or just married on paper. You know, I don't know how he quite feels about it, but there may be some financial benefit to us based, you know, in how Social Security plays out. If we were married, I don't know how long it would take for us to be married before I would gain some benefit from that. He expects to, he's 2 years younger than me, he expects to retire at either 62 or 65. So that's another piece of the puzzle. So I'm self-employed.
And how old is he?
He is 58 right now.
So what's his birthday then?
December 8th, what would that make him, 52? I mean 54, 1954.
Yes. Now, is he, did he and you adopt your son together?
No, this is where it gets a little bit complicated. I adopted him. We've been living together for 5 years. He does intend to take guardianship of Michael if I die. So I don't know if his intention is to formally adopt him. So I don't know how this is all going to really play out. That's my next step, is actually go to the legal end of things.
Of course.
Because I've got to see, you know, obviously the house, I want the house to be taken care of, whether I do life insurance or mortgage insurance. Not sure how that's going to work out, but I do know he has the intention to take care of Michael when I'm gone.
Okay. Okay. What do you, get your name on here. Tell me about your longevity in your family.
Well, my mother lived to 92. My father is still living. He's 97, and he lives at home. He does not take any medications. My brother is 60, and he's actually training for an Ironman at this point. My sister has had a history prior to 60, so she, about 5 years ago, had breast cancer, but she's a survivor, so she, there's no history of it prior.
You have no medical problems?
No medical problems, no,
Okay.
very healthy.
So when doing these projections, then, I mean, I guess we have to assume that, in assuming a lifespan, I guess we have to assume age 90 plus.
Yeah, I would think I have fairly good longevity.
Okay. Now, do you have a pension that you'll be getting, a monthly pension from your current employer or previous employer?
No, I've been self-employed since 1987.
Okay.
So, pretty much just IRAs and set money.
Okay. All right. And let me take a look at your, if I may take this
Oh,
and.
sure. That's another question, is being self-employed, obviously, sometimes your gross or your net earnings really don't reflect what you've earned. So how does that, I guess that's to my disadvantage.
It is. It is. Now, just quickly, what's your boyfriend's first name?
Terry.
Terry. Is roughly what is his income level?
He's probably now, I would say, with overtime, 65, 75. He works at EB, he will get a pension. He's been there for about 25 years. He's done well with, his investments, but we keep our money separate. He has no interest in the house. The house would go to Michael, essentially.
Well, you can always get the higher of your Social Security or half of his. Now, looking at this right now, yours would be higher than half of his.
Mm-hmm.
So that wouldn't, getting married wouldn't increase that. Now, what it could do is if one of you retired before the other, it would allow you to do some interesting things like we talked about at the workshop, where
Mm-hmm.
one of you can start to collect off the others early and then wait till age 70 and kick in off your own. So there's some ways to squeeze a little bit more out,
Mm-hmm.
but I don't think the differential will be that significant.
Mm-hmm. Yeah, okay.
So you're thinking you're at least going to work till age 70,
Yes.
okay? At age 70, and it sounds like will your son have the aptitude possibly, I don't know what the nature of the disability is, but will he have the aptitude possibly to go to college?
I'm hoping. I've started a college fund with that in mind. I just don't know. We're sort of in that beginning stage of trying to assess where he is as far as executive functioning and cognitive skills and things like that. So we'll see.
Okay. Give me his name and birth date also, because that does affect this.
Okay, Michael L. on here. Birthday December 10th, 2004.
That will play into this,
Okay.
because he, as a minor, can get benefits if you collect.
Oh, really?
So it could potentially play into this, yes.
Okay.
Okay. And
So as a
now,
minor.
are you widowed or divorced?
No, never been married. So as a minor, he can collect at what, when I start to collect?
I don't come across this often, but yes, I think the answer is that you'd have to collect first, or we might be able to do what's called a file and suspend would be really nice. Now you might have to wait until 66 to do this, but he can get a few years worth of benefits potentially. What year school is he in right now? Is he second grade?
Second grade, yeah.
Okay. So he would graduate in 2023.
Mhm.
Okay. Let me have them get started on this. let's get started working on this, and then we can come back and talk about the other part of the equation.
Okay.
Fair enough?
Mm-hmm.
All right. All right. Well, let's transition into the second portion, where we can start to take a look at the retirement overall
Okay.
and see whatever it is that the magical software spits out, and we can see how
Okay.
something that's even doable for you personally. You brought your statements.
Yeah, a few of them. I didn't have there's another one that has about 12,000 in it, but this is,
Okay. Let me go get a form I need. Did they send you a form to fill out by any chance?
no.
No? Okay, let me grab one then so I can take notes on that. Yes?
I'm sorry to interrupt. Hi, Margaret.
Hi.
I just need this figure here for the report.
We need that for the report, though.
It requires it. And it's a guesstimate.
Do you know what your annual budget is for your household expenses, approximately?
It's just a general.
Yeah, let me just, look at that. I mean, you're tracking everything, mortgage, insurances,
Yeah,
things
yeah.
like that.
Could
Just,
be.
let's see.
Looking at the lifespan here, you had a client in here yesterday whose mother is 105. She's going to be 105 this
Oh,
year.
goodness.
Isn't that incredible?
That was it last night at our event, right?
No, that was in the office
Yeah.
yesterday. We had so many clients come in, I was trying to picture who it was.
Just gonna say about 1,800
A month.
a month.
A month? Okay,
So
thank
call
you.
it 25,000 a year.
Okay, perfect, thank you.
Now you own your home,
Yes,
right? And when did you buy that home?
2005, August 2005,
And at what price?
250,
And again, it's not yours and your boyfriend's, it's just yours.
yes.
Okay. And what's your mortgage balance approximately?
179,
Do you own any other real estate beside that?
no, but I may be entering into buying a condominium for my business. I actually just am heading down to the zoning board and zoning and planning down in Madison today. I've been leasing a space in Madison for my business, but there may be an option to, lease with an option to buy on a condominium, about 100, it's about a quarter of a mile away from my current business. So I'm thinking about that, and so that may be another investment.
What is your current business?
A veterinarian.
Okay. Are you self-employed?
Yes.
You're self-employed. Any partners?
No.
Any employees?
Yes.
Are you an LLC?
Yes.
How many full-time employees do you have?
1 full-time, 3 part-time.
So, when we talk about income, net of business expenses, which of course is what Social Security is based upon,
Right.
give me a range over the last few years as to what the low end has been and what the high end has been of your profits after expense.
The last 5 years, it's ranged anywhere from 25 to 75. So it's been particularly difficult. Well, it changed a lot when I adopted Michael. I went to more of a 3/4 time practice, half-time, 3/4 time practice. And the economy the last couple of years, a lot of competitors in the area. So trying to change things, build it back up again to sell it. And that's another question is, selling strategy. So I'm also looking at going back to school, looking at medicine, and knowing that I have a lot of years ahead of me to work and to support Michael, looking at the human end of things at this point. Just getting a second degree so I have more options. So we'll see what happens.
I see you have some SEPs and the like, so let's take a look at those.
All right. What's this? Last few.
Okay. And this is a Roth, a SEP IRA, a traditional IRA. Okay. And this one here is your,
It was all SEP money on
Your
that
SEP.
one.
and this is not for your employees, this is just your portion of the money.
Yes. Mhm.
Okay. Which one have you added to more recently?
The Fidelity account.
So this one was first, and this one came in after?
It was a mix. I had Fidelity, and then when I owned my other business, I did have a SEP plan. I just happened to go with Merrill Lynch for a period of time now, and using Fidelity more. So
Hmm?
it's sort of a mix of the two, and I have some money in Citizens Bank as well. But that's.
Well, it almost makes sense, because with their new policy, it's been a decade now, where Merrill Lynch says if you're under 100,000, you can't work with a broker.
Hmm.
When you don't have a broker on this account, you call
No,
the 1-800
no,
number.
no,
Yeah.
don't.
So if you're not gonna have a broker, you might as well go to Fidelity and save yourself the fee.
Yeah, that's true.
Yeah, I remember they changed that a while ago, and that was a big
Yeah. It's
Big-
good to-
to-do, but, the brokers were upset, but
Makes it a lot easier. I was just actually a couple weeks ago down at Fidelity, just trying to talk to them about some options and just consolidate everything.
So how will you know when it's time to retire?
How will I know?
Mm-hmm.
I don't even think I'm ready to think about that. I mean, I don't have a hard, fast strategy. I feel like I was, I have not paid a lot of attention to my finances. I've been, I'm late in the game, so I think I'll be working until I get tired of it. I mean, I really don't have a strategy for that I anticipate, you know, living quite a while. I have a simple life. I don't have a lot of, you know, not extravagant. You know, my life really revolves around Michael at this point.
Mhm.
So you know, I've traveled a lot when I was younger. I used to have my own business, and I did a lot of traveling, so I've had my fill of that. And, you know, I don't know. I'll probably even work part-time into my 70s.
Mhm.
I enjoy medicine. I think I need to be stimulated in some way. So, you know, I may, if I get into that field, I may, you know, work full-time through into my 70, maybe part-time after that. So you know, I don't know.
Okay.
I don't know what to tell you.
Okay. Just out of curiosity, how did you know when you made the decision on your own to adopt Michael,
Mhm.
and being a little bit later in life than most at that
Mhm.
time to have done that? How'd you know that was the right decision? I mean, it was. I'm just curious, more curiosity than anything else. It's kind of a cool thing, and part of the reason I ask is I'm 47 now and I have children too. So
Yeah.
I wonder, well, what triggered her at age 51 to make this decision? So.
I always wanted children. I think I put my career first, and obviously it was a struggle for me owning my own businesses. And at one point in time, I owned 2 practices. I had a practice in Old Lyme and down there in Madison, and I just felt like I had a void for a long time, and I decided I was actually with the person I currently am with, and he wasn't moving in any direction. So I just decided it was getting too late. You know, it was getting later. I wanted to adopt. I had a sibling who had adopted from Russia.
Mm-hmm.
So he sort of, you know, blazed the trail for me a little bit, and so I jumped in. You know, I really, I'd always wanted a child.
Did you look into it much, or did it just feel like the right thing to do?
I think it's, when it happens, it's a leap of faith. You end up, you start the process, and it takes on a momentum of its own. And then once you're in it, and I decided that because of my age, for a number of reasons, I chose a special needs child. I think it would be, I think I would have aged out of the program if I had waited for a healthy child. So I looked at the possibilities as far as what disabilities were acceptable and what I could handle. And then you put your name in the pool and you wait.
Well, I give you a lot of credit. That's fantastic. It sounds like it just was something that you felt was right at the time.
I mean, you certainly have a lot of trepidation as you go along, and it is. There's a point at which you really just have to leap and take what you get, and have faith, and that's what I did. I mean, I had reservations to the very day I was in China. And basically, day one, you have one day to yourself when you travel. Next day, you're handed a child, and then the whole process starts. And it moves quickly. And it's really, once you accept that, I mean, once you start with all the paperwork with their government, it really is, becomes a reality. It's a little difficult.
Sure.
It's an adjustment.
Like you say, leap of faith.
It is a leap of
That's
faith.
right.
And he's a good boy. He's very, he's got his challenges, but he's a good person.
Good. That's great. Let me ask you, when you compare these 2 accounts, so first of all, you're really managing these yourselves.
Yes.
You have nobody at
Right.
Merrill Lynch helping you, but you call a 1-800 number, correct?
Mhm.
Okay.
Mhm.
Fidelity, you consulted with them over the phone, or did you go to New Haven?
I went to New Haven, yes, at least wanted a face-to-face and start a relationship with somebody down there.
So they gave you some ideas,
Mhm.
but still, they can't really give you a recommendation. They just kind of steer you a bit, and then you got to decide.
It would be my decision, and then, you go from there. I have a lot of cash that I should have invested in November when I was thinking about it, but dragged my feet. Now it's a question of when do I jump back in.
What do they say? What do they recommend?
Oh, they were just gonna put it into some mutual funds. I was gonna do, a little bit at a time, maybe 10,000, every couple of months, to just average it a little bit better. I like Vanguard funds as well. I think it's a nice group of funds, and I'd like. At this stage of the game, I probably have to be a little on the conservative side, I would say. But I'm willing to take a little bit of risk with some of it. So they were talking about just putting some into a mutual fund called a Freedom Fund, I think that they have. And, I was gonna start to look at how, I just haven't done my homework on looking at the performance of some of those funds they were suggesting, so. And my brother also, he works as a financial, one of the financial people at Xerox, so, always, when he has the time to talk to me,
Sure,
I
sure.
can run some of these things by him, so.
Did their recommendation seem like a concrete recommendation, or? Or do you need
I
more
don't,
information?
I'm one of the, I don't have enough, I don't do much with my money, I'm afraid to say, and I really need to take the time to start to learn more about it and take more of the responsibility on myself. So I think it's just a matter of educating myself as to what's out there and how to see what, sort of rate the different funds, and, at least get an understanding of what they're suggesting, so. So I'm at that point, I think.
So which funds or which performance do you feel like you like better? What you've seen here, what you've seen here?
I'm not sure I'm quite prepared to answer that question, because I haven't been following them as much as I should have. I think I like Fidelity and Vanguard. I actually had one of my clients when I owned Old Lyme, who basically took control of everything I had in the SEP, and he put it where he thought it should be. I really didn't have any say in it, and I just basically let it go, and let him take charge. But we don't really have a connection anymore. I think he moved out of the area. So I really don't have a preference. I do.
Okay. Well, let me ask you a question. I think I know the answer, but if I saw something that I thought was potentially problematic, that was outside the realm of Social Security, the reason for which you're here, would I be correct in assuming that you'd want me to share that with you?
Sure.
And I don't know if that's an issue or not, but let me ask you a couple of questions.
Mm-hmm.
You said you're at a point where you need to be a bit more conservative. As you know, in the financial markets, there's the riskier side, which is stocks as well as stock mutual funds.
Mm-hmm.
And there's a whole bunch of different investment alternatives, which to varying degrees are more conservative than the stock market.
Mm-hmm.
Okay, so you have the stocks and stock mutual funds over here, and the more conservative stuff over here.
Mm-hmm.
So the question I have for you is really simple, and all I'm looking for is a gut instinct answer.
Mm-hmm.
What percentage of your money, being a reasonably conservative investor, do you feel you should have in the riskier stuff, like stocks and stock funds, versus some combination of the more conservative things? And just a gut feel.
Maybe 25%, 25% in riskier things.
That is a smart number to me.
Mm-hmm.
So the first thing I want to say to you is, you follow your gut instincts with this stuff.
Mm-hmm.
Sometimes people go for advice from a so-called professional, and they get steered in a different direction, thinking that oh, this person's a professional, I'm not, maybe I should listen.
Mm-hmm.
And there could be some truth to that, but you also have to follow your gut instincts, and you have to be aware of if a professional is recommending something, is it because they believe it's the right thing, is it because it's their business model, and so on.
Mm-hmm.
So, for example, when you look at this account right here, this account is 100% in the stock market.
Right.
Okay. Because even the mutual funds are stock funds. You have 12,000 in individual stocks and 34,000 in stock funds.
Mm-hmm.
Now they're recommending mutual funds over here,
Mm-hmm. Okay.
which means that after you drip it in at $10,000 increments, you could very well end up being 70, 80% in the stock market,
Mm-hmm. Yeah. Yeah.
which is a far cry from your gut instinct.
Yeah. Okay.
Now, I mean, this alone, if I add this together, you're at 120,
Mm-hmm.
and this represents almost 40%. So right now, you're already at about 40% in the market,
Mm-hmm.
just with this. Oh, and you have 15 in the market over here. So I guess when you add it together, you're probably 45% in the market.
Yeah.
So if you put this in mutual funds, you're already more aggressive than your gut tells you should be,
Right.
and you'll be even more so if you follow that advice. You with me?
Yep. Mm-hmm.
But really simply put, you have to think of it this way.
Yep.
Fidelity sells what? What's their model?
Mutual funds.
They're a mutual
Stocks.
fund family.
Yeah.
So they're always going to recommend mutual funds no matter what.
Mm-hmm.
That's their model, that's what they have.
Mm-hmm.
Merrill Lynch is a brokerage firm. And there's a reason stockbrokers are called stockbrokers. Typically favor stocks.
Yeah.
So they're always going to recommend stocks and stock mutual funds, and Fidelity is always going to recommend mutual funds.
Yeah. Okay.
Now, you said 25% in the market was a good number, just
Yeah.
kind of as an overall gut feel. Okay. So now let me ask you another question.
Okay.
I want a gut instinct answer.
Okay.
As you know, the stock market in the 1980s and 90s was the best it's ever been. Literally, we had the best 20-year period ever.
Mm-hmm.
Since the turn of the century, that hasn't been so strong, however. Since the turn of the century, the market basically did this. It dropped by 50%, recovered, then dropped by 60%, and now recovered and just hit a new record high, just got a little bit above its previous high.
Mm-hmm.
As happened back here in 2007 for a period. So now the $64,000 question is what's going to happen next? And of course there's two schools of thought out there. One school of thought says, yeah, the worst is over, things are looking great. Yeah, we won't have another 1990s stock market, but with some bumps and bruises we'll be trending upward.
Mm-hmm.
Okay. The other school of thought out there is where people say, well, wait a minute, time out. You know, the market being this high doesn't make any sense. We'll probably have a few more major drops in recoveries before we have our final permanent recovery. The question I have for you is quite simple. Which of these two scenarios does your gut instinct tell you is more likely?
I'd say just from what little I know, I think the second scenario is most likely, that it's overinflated right now. It's just, it can't sustain, and it's gonna have to fall at some point, and then correct.
Again, that's why I encourage you to follow your gut instincts. If I were to say this, tell me how you'd respond to this if you agree. Do you believe that, generally speaking, history tends to repeat itself more often than not?
Yes.
Well, I believe that too. And that interpretation of historical data would draw me to the same conclusion, the same feeling that you have about the future of the market. Okay? Just going back a century. You've heard the market average is what, 9-10% over the very, very, very long run?
Mm-hmm.
Probably heard that statistic.
Mm-hmm.
Well, if it averages 9, the way it breaks down is 6 to 7 of that comes from growth, and 2 to 3 comes from dividends. But that growth comes in historically in clumps. It comes in very predictable, repeatable cycles. We've had huge periods of time where the markets has 0 return, and huge periods of time where the markets average double digits. Okay. So if you're investing your own money, wouldn't you want to know this? So when they say, when you talk to people like Merrill Lynch or Fidelity, and they say over the long run the stock market outperforms other things, they're telling the truth. Okay? But what you're not seeing is the breakdown of that truth. For example, let's say, you remember Jay was at our program. Tall guy, big guy, younger, he's my younger partner here.
Okay.
Jay was there back in January. And let's say I told you that Jay and I jog an average of 10 miles a week. You get a picture in your mind.
Mm-hmm.
And you might think, okay, it's summertime. We have shorts, t-shirts, we're out there, we're running.
Mm-hmm.
In wintertime, we've got sweatpants, jackets, hats, gloves, we're out there and we're running, right?
Mm-hmm.
But what if I then told you that the way I had derived that 10-mile average is that he jogs 20 miles a week and I don't jog at all? That would paint a different picture, wouldn't it?
Sure.
Now, did I tell you the truth when I said we average 10 miles?
Mm-hmm.
Yeah. Did I tell you the whole truth?
Yeah.
And now that you know the whole truth, it paints a different picture. Same thing is true here. Yes, it averages 6 to 7 growth, but it comes in clumps.
Mm-hmm.
So just going back to roughly 1900, we had a period of time from 1899 to 1921 where the market had 22 years of 0 growth. A lot of volatility, good years and bad years, but they all washed each other out, resulting in 0 growth. 22 years. And we had a period of time from 1921 to 29 where the markets did incredibly well through the roaring 20s. And then it all crashed in 1929 when we went into a period, this time 25 years, where the market had a lot of volatility, good years and bad years, but the good years and bad years all washed each other out, resulting in 0 growth for 25 years.
Mm-hmm.
And we had a period from 1954 to 66 where the markets did great. And then we had another bear market from 1966 to 82. This is the shortest we've ever had, only 16 years, where again, the market ended up with a lot of volatility, but 0 net growth. Where the market would drop and come back and drop and come back and keep doing that, but kept bumping up against this glass ceiling. And of course the market took off in 1982, like I mentioned a moment ago, and did quite well. And the last bear market started in the year 2000. Now, how long is the average bear market according to this?
Quite a while.
About 20 years or so.
Yeah.
In fact, the only one that was shorter than 20 years is this one here.
Mm-hmm.
Now, if you went back to the 1800s, believe it or not, and the stock market records, they're not readily available, but if you dig and do research, you can find records back in the 1800s. And I actually have done this research back in the 90s. Back when we actually had to do it on microfiche. I had to pull up microfiche in the libraries to get it. And believe it or not, these cycles look pretty much the same.
Hmm.
So of course, you have to ask yourself, is it possible that this is the first time in nearly 200 years that the market recovers and takes off after only 13 years?
Yeah. Okay.
Well, of course it's possible. Anything's possible.
Yeah.
But according to market history, is it probable?
Probably not. No.
It's much more likely, according to history, that the market's going to be stuck in the muck for another decade or so.
Mm-hmm. Mm-hmm.
So again, that's why I say trust your gut instincts. Okay. Not to mention the fact that now we're back at the peak. We had a 50% drop and recovered, a 60% drop and recovered. Okay. We've never had one of these bear market cycles that's had fewer than 3 drops. Every one has had 3 or more major drops. Again, how many have we had so far? Just 2. And it's very common, it doesn't have to happen, but it's very common that these drops get bigger and bigger. They go in waves. Okay. So, you know, to me, now that we're right here at the record peak, we're right up here, you know, history says we have very little upside, but we have a ton of downside. Just to match the last low, the market would have to drop more than 60%. Okay.
Yeah.
So I share that with you, and that's where I said, you know, would you want me to share with you something outside of Social Security? Because Merrill Lynch is happy to have you in the stock funds, because that's what they do. Here we are at a record peak in the market, with far more downside than upside, arguably, but yet, you know, Fidelity is recommending that they go in. Now, to their credit, they're recommending you do it in increments, because I think they're a little worried that the market's high. But they also know that they have limited tools in their toolbox.
Right.
So they're saying, well, we want her to invest, but we don't want to put it all in right now because we know things are high. Whereas, once you know this, and once you know how predictable and repeatable these cycles are, you know, wouldn't that lean toward not putting any more in the stock market today?
Yes.
Moreover, you know, if you really believed history repeats itself, as I do, because I've studied the last 200 years, wouldn't it lead to the possibility of saying, gosh, not only do I not want to put any in, but I might take some of the other monies out of the market since the market's so high?
Yeah. No, what becomes the alternative? Just putting it into, I mean, in that context of retirement money, where can you move it?
Well,
What do you have as options? CDs and...
you can invest anything inside of an IRA.
Okay.
Here's the universe of investment options according to Dave Scranton, the way I look at them. Right? There are 3 basic categories of investments. I'll erase this top part here. On the right are your stocks and stock funds. That's the riskier part of the spectrum. That's the part that most of the financial world and investors got addicted to in the 80s and 90s. Best stock market in U.S. history. As a country, we became addicted to the market, addicted to mutual funds. You know, Fidelity and Vanguard, they just mushroomed in the 80s and 90s. As the stock market was doing well, they grew exponentially. I also worked in this side in the 80s and 90s. But because of my studies of market history, which I just erased, I knew in the late 90s that the good times were about to end, and that this was about to happen. So in 1998, I changed my business model from being a stock market-based model to being one who specializes here and here, which is rare. It's kind of like in the medical field. Most chiropractors will never recommend orthopedic surgery. Most orthopedic surgeons never recommend chiropractic. They don't cross over. I was the one guy who looked at my stock market model and said, this isn't going to work for the next 20 some odd years for my clients, and actually switched. So what are these options? Well, on the left are things that have no risk. They're generally considered to be insured by some governmental authority. CDs, government bonds, fixed annuities, insured municipal bonds. In the middle are things that aren't insured by governmental authority, but they're considered a lot more secure than this. These are things like corporate bonds, indexed annuities, preferreds, and the last one is something called a REIT. I actually take some literary license to put the REIT in there because the REIT, you can kind of sort of put it over the right too. The reason I put it in the middle is because it pays more income than the average stock. So all the things here on the left and the middle have two things in common. First, they're all much more conservative than the overall stock market. Second, they all generate income. You invest in them not for growth, not for capital appreciation, instead you invest in them for interest and dividends. And especially with IRA money and Roth IRA money, if you don't need the income today, you reinvest it to buy more. So it's what I call growing your money the old-fashioned way, growing it organically through the reinvestment of interest and dividends. Okay.
I do have a question about that. In the context of also Social Security, am I correct in understanding that with a Roth IRA money, with traditional IRA or set money, you need to start to take distributions at 70.5, whereas with Roth, you do not have to take those distributions. So is it an advantageous time to switch and convert as much of the traditional or set money into Roth money?
Well, the downside is you have to pay the taxes on it when you do that.
Well, if I'm at this point in time in a tax bracket where it's fairly low, I have to talk to my accountant about this, but in anticipation, if I'm going to be, possibly buying a property and my business is a little bit down, we're trying to sort of ramp it up again. I'm expecting my income is going to be a little bit lower than it has been previously whenever I make a transition like this. Is it a good time to do that?
As a, the financial advisor hat goes on, and there's an argument for that. But the other side of it is that ultimately, when you do retire and take income, you're not going to have as much income coming in. Even if we grow this to $500,000 by the time you retire, and you take $20,000 a year of income, that plus Social Security should still keep you in the bottom bracket.
Okay, so really at that point doesn't make a difference.
So to pay tax in the 15% bracket now, as opposed to later, doesn't make sense because now you can have all this money working, compounding for you.
Okay.
So you have more money generating income.
Okay. Right, okay. Right, okay.
So the point up here is simply this. If you've got you have 125, right now you have 125.
Oh, actually, I have another 11,000. No, I've got about 138. I have some money in, it's actually in a Citizens Bank, in a Roth.
In a bank account or a mutual fund?
It's a CD.
CD, okay.
Yeah.
All right. So if you've got that in there, 138. And right now you've got about 65 stocks, stock funds. That's the Merrill Lynch. Plus 15,000 of Fidelity is invested in mutual fund. That means you've got about 73 over here in conservative stuff. Unfortunately, your conservative stuff is a money market making basically zero. Okay. To get from where you are to where you want to be at 25% is I think a pretty good gut instinct answer. You have to take 30,000 out of the market and add it in over here. If you did that, you'd end up at exactly 25%. So again, to get from where you are to where you feel more comfortable, you've got to make a $30,000 risk reduction. You see that?
Mm-hmm.
Now, of course, the question becomes, like you said, you don't want to put it in the money market. In fact, you went to Fidelity because you want to take some of the money market money and invest it in other options, because you don't want to make, 0.1%. And rightfully so. You can't afford to. I mean, you need to get this growing.
Yeah.
Which is the same reason you want to be in the market, because you can't afford to take losses. You can't afford to go backward.
Yeah.
Right? And that's where this realm up here is the realm of alternatives that can help you do that. And this, what I throw up there on that top little teeter-totter thing is basically the universe of options. It's the universe of non-stock market options.
Some of which I have to say, I don't know anything. I've heard of REITs. I mean, I understand the more conservative and government-backed, but a lot of them in the center, I really don't have any idea about. Which actually it brings up another question. With the idea of selling my business, how does that play into Social Security? And I suppose it would make a difference as to if there's real estate attached. Now, if I were to, let's just say I buy this property, I keep it going for another 5 years, I sell it, and now I have a practice, plus I have a space. I mean, I suppose you could sell it all as one. You can sell the business, or you can, you can actually have them, lease with an option to buy the property. You could sell it outright and have them finance it. You could do seller financing. So how does all of that impact income and Social Security when some transaction like that happens?
It would really only impact taxation of Social Security benefits.
Okay.
If you took Social Security before age 67, then it would impact it how it's taxed, and you probably wouldn't do that, because what you told me, you're working. My guess is you're probably going to wait all the way to age 70 until you can get the maximum benefit. I think that's how the numbers are going to come up.
Right. But if I were to sell, well, I guess then
If you sell a business or a property, it's not earned income, so it doesn't count toward your Social Security.
Right, yep. Okay. And I would sell it with the intention of going into another line of work or another option. Basically thinking of, physician's assistant or something like that. Not that I'm burned out in the veterinary field, but it's actually, used to be a recession-proof industry, but it's harder and harder to find work, and at my age, it's hard to work for somebody else. I'm tired of running the whole show by myself. I still want to stay in medicine, but do something a little lesser, without as much responsibility. So, that's what I consider retirement.
Yeah, sure. Sure.
Still keeping my mind active, but just not have, be able to have a set time of arrival and departure, and that would actually be an easy street for me, and maybe even a part-time type position. So I, that's why I say I'll probably work till beyond 70, but I may make a career
Differently,
switch.
yeah.
So,
Well, on the real estate, I'll tell you this. I don't see real estate having a lot of upside potential. I think there's going to be another shoe to drop in the real estate market. And because usually when these things go, they don't just go in one wave. You know, we had one down wave in 08 and 09. And real estate started to come back a little. But if the stock market continues to do this, you know, if there's another major drop, people aren't going to want to go out and buy real estate. So I don't see there being a lot of upside there. What I see is the possibility of you complicating your life by buying a property. And then when you go to sell the business, now you've got to, gee, are they going to want the business and the property, or just the business? Now you have to hold the property. That's where it gets complicated.
yeah, yeah.
So, you know, with your priorities being different now, your priorities being, okay, number one, I want to spend a lot of time with my son. Number two, I might want to sell this in 5 years. You know, that tells me buying the property doesn't make sense because you're looking at a 5-year window.
Yeah, I am a little old to think, I mean,
I was thinking about buying this property, and I still am, from the owner. He's pushing me to buy the whole thing.
yeah.
You know, we have a third of it, but there's more. And you know, the difference is I see us being here for 20 years. And I'm
Yeah.
still skeptical because I don't see a lot of upside in this market with real estate, and I'm concerned about, I don't want to complicate my life unnecessarily.
Yeah.
So if your goal is to keep things simple,
Mm-hmm.
and give you the flexibility you want, so that, gee, if you do want to do something different in 5 years, you can. Then, you know, I would advise you, you know, not to, unless it's a great steal. I would say stay away from buying. Which I can't imagine there are any great steals today in Madison, Connecticut. That's my best guess.
Yeah, I hear what you're saying.
And I assume that's kind of where the direction you're going in. You're trying to keep things more simple, not complicate them.
Yeah, I'd have to say that I am. You know, I think the business has lost value. It's unfortunate, but partly because of my life changes, but I think also just, I didn't anticipate the kind of competition. I had a practice in Old Lyme, which was a great community, and I had an accountant who actually advised me, well, he didn't like what was happening with, you know, the practice. It wasn't growing enough and what have you. So I bought a practice in Madison. I owned two for 5 years. I owned two of them, which was absolute insanity. Madison doesn't suit me at all. You know, just the personality. Old Lyme was an incredible, wonderful community, but it is tough. It's tough to, as a solo practitioner also, when you've got competition from a lot of other larger hospitals. So I didn't do my due diligence on that, and I'd have to say that you know, I probably am looking for an out, maybe even sooner than 5 years, if I decided to change.
Well, then, if your goal is simplicity, is what I'm hearing, then I would say I would push you against buying the condominium. It doesn't make sense.
Okay, all right, well, that's good advice.
So, let me ask you here then. I mean, you probably realize now from what we've said that because Fidelity's business model is mutual funds, that they focus on the right side, not the left and the middle. So now the question is, how do you want to go about doing this here? I mean, you need, you know, to get from where you are to where you want to be, you actually have to make a mutual fund or stock market reduction. And then you don't want to sit $103,000 in a money market.
No.
So now the question is, you know, how do you want to handle that? Do you want to, you know, do you feel the need to complicate your life there by studying, you know, all there is to know about the things on the left and the middle? Or to, you know, have help with that, to work with somebody who can kind of steer you and guide you through that process?
Well, you know, obviously I like to educate myself to understand things. I've always been, felt more comfortable, being a part of it and understanding it a little bit. And I'm not a financial person, which is pretty evident. But I think having help, I think that is, I'm probably at that point because I know my personality. I know also the demands of running my own business and also having Michael, and I have a 97-year-old father that I often take care of. So,
Right.
It's getting, it is, I need to uncomplicate a bit. And so to having someone give me solid advice I think is appropriate. The other side of that is, I guess I'd have to ask you when you sign on with an organization like yours, what fees are we talking about? What does all that look like?
Well, philosophically, I am opposed to charging a fee unless we were managing a portfolio of individual stocks, which is not what we're talking about here. What we would do is we would get you down around that 25% stock market exposure, or maybe even lower if you were comfortable seeing that the market's so high right now, by simply keeping some of the funds you have. Carve out the funds that are not so good and keep the funds that are better. Then we would take the rest and take some time and educate you and help you allocate amongst the things on the left and the things in the middle. But the good news is because all of that work that we're doing is not in the stock market, we won't charge you a fee to do it. Like, I'm against charging a fee for that. Now, that doesn't mean we don't get paid. Of course we get paid.
Sure.
But in the realms on the left and in the middle, we get paid. Our payment is built into the particular investment. So the best analogy that I can make is that we get compensated the way the travel agent used to get compensated. If you went to a travel agent to buy an airline ticket, let's say a decade ago or more, or you went direct to the airline to buy that ticket, the cost to you was the same. Yet you knew that if you bought it from the travel agent, that travel agent was getting paid from the airline. That's the best analogy for how we would work with you. For example, let's say we bought just a lowly bank CD on your behalf. I don't know why we would, we probably wouldn't, but just for an example. You'd get the same rate as you'd get if you went to the bank. You get the same rate here. But because we did it for you, we'd get paid from the bank. We get a finder's fee from the bank, just like travel agent. So that's the best explanation of how we get compensated. I find that a lot of do-it-yourselfers like the process that we take new clients through. Some advisors, especially those that charge a fee, tend to say, look, give me the money, let me just go ahead and do the allocations, and you'll get the confirmations in the mail after we make trades. That's not how we work. My philosophy is that I want to take some time with every new client, invest some time up front to educate that new client about these different options. So the first step is that we need to become broker of record on accounts before we can even help you. So when somebody decides they want to work with us, then we become broker of record. That doesn't change anything. It just means that our name shows up on top as the broker so that we can access daily information. Once we do that, then we talk about what to keep and what to liquidate to lower your risk. We look at the current holdings, and if we want to lower your risk by $30,000, we figure out what to keep, what to sell. Once you do that, you can kind of wipe your brow and say, okay, now we're safer. Then we invest some time going over what we call my Conservative Money 101 tutorial. This is where we educate you about the things on the left, the things in the middle, their expected returns, their risks, their pros and cons. At that point, if you're like most clients, you give us some good informed feedback. You say, Dave, in the way you describe these things, I like these 2 or 3 better than the rest. Once we know that, then we can start to put together a recommendation, some combination of those 2 or 3 with which we think you'll feel comfortable. And then only once you and we agree that this is the right allocation do we go ahead and implement it. Not before. And that's why do-it-yourselfers tend to gravitate toward us, because ultimately that do-it-yourselfer client is still in the driver's seat. It's kind of like a sporting event. The coach can't play the game. The coach can just coach the players to get the most out of them. And that's how we look at ourselves. And that's what we do. So, and that's up to you. I mean, I just, it looks like you do need some help here. The mutual fund recommendation isn't going to fit according to everything we talked about today. And especially seeing that you're already over your goal. Your gut feel was 25%. You're already close to 50%. And I think now's a good time to be stumbling upon this. This is why you're here, and I'm sorry to have taken so much time with this, but I think this is a good time that us having stumbled across this, because again, with the market back at that glass ceiling, at that record high, knowing that every bear market has had 3 major drops or more, so far we've only had 2, I'd encourage you to make a decision you're comfortable with, but not procrastinate unnecessarily because of where we are.
Yeah, okay.
And it makes it seem a little easier because you don't have really a relationship with any advisor there. If you had an advisor with a long-term relationship, it might be a challenge. But that doesn't seem to be the case.
Okay.
Any other questions on this? I'll go check on the Social Security report.
No, I think it's fairly straightforward.
Okay. We'll read that report then.
Sure, okay.
I know we got off on a few tangents here, but luckily we
No,
had the
that's
time.
very helpful for me.
Important tangents nonetheless.
Very important.
And you can take this and kind of read this through and call for questions also. Talks about the assumptions and everything else that's in here.
Now, if I can, because I've had some poor earning years, obviously maximizing my earnings over the next 10 years can help increase that level, I would assume. The level I'm entitled
Yes.
to at 70. And there were a few things that I wasn't quite sure on. The cost of, there is a cost of living adjustment, because from your lecture, I can't remember if you said that, is there not only from 66 to 70, you do earn that extra 8% per year by delaying retirement, but is there also a cost of living increase?
You get the cost of living plus the 8%.
Plus the 8%.
And plus, if your income's higher, then that actually helps you.
Yeah, so, okay.
So that's definitely going to be yeah, if you look at, they just compared 62 to 70, for example, and your break-even point with those benefits is right around age 80. So if you live past age 80, you're ahead.
Okay.
You know? So what you have here is if you start at 62, you start here.
Right.
And if you grew it, it'd be similar if you started at 66, your break-even is going to be right in there. You see how this goes up and up and up and up? Okay? And then instead, if you just waited, instead of having 1,700 at age 70, you'd have almost 3,000. And that 3,000 would go up, so I mean, it's
Right.
close to double.
Right, right.
And this is your break-even point cumulatively, because, you know, here, the 479 cumulative benefit is greater than the 460. Once we go down here, age 81, 508 is greater than the 507.
So that
So-
continues to grow with this is just a cost of living increase
Mhm.
over this time frame from 81 to 90, so it's quite a bit that you can,
That's just the average 2.5%.
yeah. That's,
So you definitely don't want to do anything before 67, full
Mhm.
retirement age, because you'll have to take, if you do that, you'll actually have to, yeah. Yeah, they're assuming a file and suspend in around age 67, your son could start taking it and take it for,
okay. Age 67. So he could take it for 3 years. He'll be 18. Yeah, he'd be 18, is that when
Yeah,
he's considered?
that's right.
Okay. So he'd be 18 in 1970.
So
And he
you-
had 20s.
so you don't want to take it until at least 67, because if you're working, you'll have to, you know, give some of it back. If you're making enough money from 67 to 70, you don't want to take it and just let it grow.
Right, so file and suspend, so the
Well,
filing.
the question is, what do you need to do? With a spouse, you could do file and suspend, let's see. Yeah, and I don't, as you can imagine, we don't come across this too often. I need to look into that, because what they're saying, there's somewhere here, they're actually saying two options. Number one is take it early, and he gets, let me see here. You take it early and you get 1,100 a month, and he gets 750.
Take it early, meaning as early as 62.
62. Yeah, and they're saying the better option is to wait to age 70
Right.
and have him not get it at all. So I need to do a little research on this, because I don't see this often.
Mhm.
Again, I just don't, you know, come across it. It seems to be saying that he could get benefits even if you delay it. So I need to look into that and get back to you.
Okay. Can
Make sure you have the
you,
right answer.
can you only file and suspend at the age of 66 and a half, or can you file and suspend at 62?
No, it's gotta be
Yeah, it's gotta be
66 and a half or
66 and a
later.
half or later, okay,
Right.
okay.
And I just I don't want to give you wrong information with this, and I don't even know if file and suspend is what you do with a child.
Okay, oh, right, okay.
That's a
It's
spousal
spousal
thing.
type thing, okay.
So, Oh, this is generic. Oh, I see. No wonder why I get confused here. It's saying, let's say that Sue retired at blah, blah, blah age. Just generic thing. Okay. I see. It's totally generic. Okay. So what it seems, and I'll find out if you have to file. Yeah, you do. There we go. Take advantage of strategy, pay close attention. File and suspend, August 2019, age 66, which makes your son eligible for benefits. If he's 18, or until he graduates. And then you begin your benefits at age 70. Okay,
Okay, so that's the best.
that's the answer.
Okay. And he's eligible for what level of benefits? It's a percentage
About
of?
12,000 a year is what it looks like.
12,000
Yeah.
a year.
So you'll see right here on the chart, you wouldn't collect your 2,900 until age 70, but he would start to get benefits right here,
Oh, okay.
and you get them for, and you get a part year here, and he get a part year here, so this is kind of a total that's combined. And then you get them really until he's 18 or graduates, whatever's later. And then,
How is that considered as income then? Is that my income, or is that's a benefit to him?
it's his income.
It's his income,
It's going to be tax-free.
tax-free? Okay.
So at full retirement age, you're going to want to file and suspend, so get in there around age 66. And
Okay, one suspend, and then he, 12,000 per year for those 3 years. Well, let's put that toward college or his teeth. He's got a cleft lip and palate, so
oh,
we're looking at some implants
Mhm.
when he's that age, or older. But
Yeah.
college could go into the college fund or something.
do they wait to that age purposely with that kind of thing?
Actually, they sometimes wait until they're into their 20s. So right now, we've got to do, he's anticipating we start with braces and expansion, then we go with a bone graft where the cleft was. And there probably is going to be some facial reconstruction, which at that point in time, 18 to 24, somewhere in there, you may have to have a little bit of facial reconstruction. There's sometimes even as much as moving his jaw forward, to match his bottom jaw. So, there's a fair amount that may not be covered by insurance at that point. So we'll see what happens. He's in good hands. He goes to the Shriners, but they only cover him until he's 18 years of age. So beyond that, it's
Toughest part with that kind of thing is just socially in school,
yes,
That's the
it's a huge thing.
that's the challenge
Yeah.
I can imagine.
Yeah, it's, and kids he's Chinese, so they've already started, he's already experienced some of the bullying because of his ethnic differences. So, and his face, actually, China did a good job, and the Shriners did a very good job with his initial surgeries. So he looks okay at this point, but, he'll obviously have changes over that very social time.
I didn't ask you one question here. Cash reserves?
Oh, I have, right now I have 40,000 as just an emergency fund, and I've got another 20,000 saved for, we're gonna, hopefully do a few renovations on the house. So, 5,000 for Michael so far, and then hopefully put it in a chat fund, or set up a chat account. Or do you have a different recommendation for what to do with education money?
Well, any 529. I mean, it doesn't have to,
529,
doesn't
yeah,
have to be
yeah,
Chet
yeah.
specifically, but
Yeah,
anyone.
yeah.
Okay, well, that's a good emergency fund. I'm glad to see that. So where are we gonna go from here? You tell me. What's your next step in making this decision?
Well, I think I'm comfortable, I think the fact that it's convenient, it's local, you and your team are very knowledgeable, and, you know, I need to start somewhere. You know, it's a matter of, you know, I have procrastinated because I keep trying to find the perfect scenario, and, you know, I just know myself in that, you know, I'm consumed right now with all the other things that are going on, so, you know, I do admit I need help. And I think I have had a little uncomfortable just going to, you know, I've been to Fidelity, and I know they're somewhat self-serving, and, you know, I met with the fellow, but I didn't really want to jump in at that point in time. So I think I'm comfortable moving forward, you know, understanding more options and making some educated decisions. I know I don't feel quite comfortable with where I am, so I think we can move to a next step.
And, you know, again, I just want to reassure you that we won't make any changes until you give us the green light at each step. You know, I mean, technically, I don't think it's ever happened, but technically it's possible that we can go through our whole process together, and you don't like any of our ideas or recommendations, and you could transfer all your money back to Merrill Lynch and Fidelity. I mean, you think about it, it's kind of sort of like a, you know, money back guarantee in a way.
Mm-hmm. Now, in terms of, so all this comes under your umbrella, or how exactly does it work? Some of these things have to be liquidated, so now you say that it goes under your umbrella, so in doing that, there are obviously fees in making the transfers, correct? Or
Merrill Lynch will have probably $100 fee to close the account.
okay.
Maybe 150, I don't know.
Okay.
Fidelity's, I think, will be more modest, because we clear through First Clearing, which is a branch of Wells Fargo.
Mm-hmm.
So your statement will look a little bit different. And we're not going to sell anything at this stage. All we would do is set up the different accounts, and what will happen is all the accounts will, you know, you'll get a statement one month that'll show 0 here and 0 here, and you'll get a Wells Fargo statement showing all the holdings.
Mm-hmm.
You know?
Mm-hmm.
And on the Wells Fargo statement, our name will be on here as the broker of record.
Mm-hmm.
But before that even comes through, we'll start our process with our meetings,
Okay.
where we can have a meeting and talk about what to keep and what to liquidate. You know, we can start our educational process.
Mm-hmm.
It just depends upon your schedule and so on. But and you know, I've been doing this for 26 years, all I've ever done since college.
Mm-hmm.
I have a master's degree in financial planning.
Mm-hmm.
I don't have an MBA or anything more generic. I literally have a graduate degree in doing this for individuals.
Mm-hmm.
I'm a certified financial planner,
Mm-hmm.
and I'm also a CFA, a Chartered Financial Analyst, which is something a lot of Wall Streeters have. Very few financial advisors have it, but it definitely gives me a very different look on what's happening out there. So
Mm-hmm.
I think that's great, and you know, simply put, you know, my philosophy with clients is, you know, if you're committed to us, we're committed to you. You know, if you say, fine, I want your help, we'll take as many meetings as it takes to go through this educational process and get you comfortable. Fair enough?
Okay. And I do want to talk to Terry about it all too, so it doesn't, I mean, is there, you know, a commitment at this point in time, or just, how do you go forward from here?
Well, it's up to you. I mean, if you were ready to give me the green light on us being the broker of record today,
Mm-hmm.
I'd simply sit you down and do some paperwork to help you, to get started.
Okay.
And then we'd schedule a couple follow-up meetings to begin our process.
Okay. Yeah, let me just chat with him a little bit, because I do want to find out where his involvement is, and I do, you know, want to talk to him about these findings as well, and see if there's any different input he might have. I'd just like to share it with him because he's involved, you know, to some extent. And then what would I do? Just come back here, fill out the paperwork, and go from there?
So may I make a suggestion regarding this then?
Yes.
I'm gonna be traveling, I'm here this week and next week,
Okay,
and then I'm gonna be traveling after that for a couple of weeks.
okay,
We have another company where I actually teach and train advisors across the country. We have a couple hundred advisors we teach and train. They use our research and so on, so I end up traveling a lot. But what I was gonna suggest was, if we can find some common time next week for us to get together again,
that's fine.
then that way there we can start the process and not push it back. Because again, I'm just, my only thought is that I hate to see a
Drop.
a third drop start, and then, all because I'm traveling and we can't do this for another 4 or 5 weeks.
Okay. Actually, Tuesday morning, Wednesday morning, actually Monday, to check my schedule, I'm not sure about Tuesdays. Oops, I just, let's see, we changed our schedule. Wednesdays are my day off. I do have a commitment at the school at 10:45. So I can do either early morning or late. I can do after 12:30, or I can do early morning on Wednesday. Also, I have to check my work schedule. I just changed it around a little bit. I'm probably available Tuesday afternoon as well.
Okay. Ideally, I'd like to pick a time when my partner Jay is also here,
Okay,
because we kind of work as a team with our clients, so I'd like you to meet him.
okay,
But what we can do is we can go, I'd like to take a copy of this, so I have this, so if you call with a question, at least I can talk intelligently.
okay,
And then what I would do is we'll go over to Andrea's office and have her pick a time
okay.
that works for all of us.
Okay, and is it possible for you also to make, I'm at a point where I'm trying to look at life insurance and what to do with that. Would that enter into the picture of some of the things I was choosing in terms of, a whole life policy versus term insurance versus mortgage insurance to cover the house in the event of my demise? That would be something important to look at.
Yes, we can help you with that, no problem.
Mhm.
That wouldn't affect your investment decision, because this
Right.
is all IRA money, but
Right.
yes, that's something we can look at. And that might affect whether you do a 529 plan or not. If you get into
Right,
a more
right,
cash value-based
sure.
insurance, you may not want to do a 529.
Yeah,
Otherwise, you might do term insurance and do a 529, so we can address that.
yeah, that's, I want to do it before I'm 60. I don't know how insurance companies look at that right now. I'm not sure if they still, they consider me to be, because I'm so close to the 60-year mark.
Yes,
I may be
It's-
considered more 60
it's
than.
nearest age, yeah.
Nearest age, yeah.
Yep.
Okay, but just looking at that, and what else was there? Yeah. I guess that's it. All right,
Right, so let's get you in for next week, we'll pick a time. I'll go over to Andrea's office to do that. If you have questions between now and then, give me a call, but I'd love to be able to help you with this. I think it's your goal to be conservative and so on, I think it's a perfect fit for what we do, and I know we can help you.
I can't judge myself against other people, but am I way behind the 8 ball as far as where I am at this point in my age?
Yeah, a bit, yeah.
Yeah.
But the other side of the coin is that let's say you could double this money between now and 70.
Mm-hmm.
Now you're up to 260, 270. Now you add to it over the next few years, so maybe you're up 350 somewhere. Your Social Security you saw was $3,000 a month, so if your monthly budget's only $1,800, $3,000 a month isn't bad.
Mm.
Plus you can get an extra $1,000, $1,500 a month from these monies, assuming what I just mentioned, getting it up over $300,000.
Yeah.
So you're not going to be in a bad situation.
Yeah.
College is going to be the wild card.
Mm-hmm.
College is the wild card. How much do you need to leverage your retirement to get to college?
Mm-hmm.
The good news is we actually have somebody who specializes in helping you maximize financial aid.
Mm-hmm.
So in some ways, if Terry has more assets than you, it might be better,
That we stay single.
yeah, because any asset in an IRA or Roth IRA doesn't count against you for financial aid.
Mm-hmm.
The other thing that doesn't count against you is cash value life insurance. It's the whole life. So we can actually plan so that you can maximize your financial aid. And if you retire right about the time he's ready to go to college, or make very little income, or
yeah.
collecting Social Security,
Yeah.
he'll be able to get a lot of financial aid. They won't really touch your IRAs or anything. And that's the way we need to kind of get you through that. But yeah, you are behind the 8 ball, generally speaking, but you already came in here knowing I've got to work to 70. And if you're willing to do that, and we do our job over here, which we will, you should be fine.
Yeah, and I expect, I mean, my father's inheritance will probably get 100,000 from that, and the practice I might get, if I'm lucky, 200 from that. And so that would be nice. At least something. And I live simply. All I want is, like to keep the house here and maybe even buy a place in North Carolina or a second condo, something like that. Simple life.
Sure.
Own a horse.
Right. That's good. You're a veterinarian. Good.
Yep.
Think about all the veterinary bills you could save by.
Oh, yeah. I can still work with them.
This is yours there. I'm gonna make copies of this. I'll have somebody do it and get these back.
Okay.
We'll get you scheduled in with Andrea, and I look forward to seeing you next week.
Okay, all right.
And if Terry wants to come, he can too.
Okay.
I mean, ultimately, my guess is this is your money, it's your decision, but you kind of, because you've been together for so long, it's nice to get at least a seal of approval. You probably feel more comfortable that way.
Yeah, just a question. I mean, I guess the government does not consider common law situations when it comes to Social Security?
No.
No, legal.
And, well, in this state, there's no such thing as common law at all.
There isn't? Oh, I didn't realize that. Okay, well,
No.
that's good.
Yeah, so,
We keep our, I mean, I think that's the way he likes it. I think that's the way it's gonna end up being. We just act
What?
very independently.
so why ruin a good thing? It works.
Yeah,
right?
it
As long
works,
as
it does, yeah.